Today, we're jumping right into a huge, high-stakes debate that's happening deep inside the insurance industry. It's all about something called Severe Convective Storms, or SCS for short. Now, these aren't just your average thunderstorms. We're talking about a multi-billion-dollar problem. And the real fight? It's over the incredibly complex models used to predict their costs. This is a battle over how to price risk in a world that's constantly changing, with billions and billions of dollars on the line.
And just to give you a sense of why this is such a big deal, you only need to see this one number. Over $33 billion. That was the insured loss from these storms in the US in just the first half of a recent year. That's a staggering amount of money, and it really puts the enormous financial stakes here in a sharp focus.
And this chart right here, it really drives the point home. You can see that when you compare SCS to other major catastrophes, things like wildfires and cyclones, it's not even close. SCS is now the main event, the primary driver of catastrophic losses for the entire industry. And that intense pressure is exactly why getting the models right has become absolutely critical.
So you might be asking, how did we even get here? For years, all the talk in the catastrophe world was about hurricanes and earthquakes, but that's changed. Severe convective storms are, without a doubt, the new storm king, and because of that, their models are now front and center, demanding everyone's full attention.
So what exactly are we talking about when we say SCS? Well, these are localized but really powerful weather systems. Think intense thunderstorms that can spawn tornadoes, destructive hail the size of baseballs, and powerful straight-line winds. But here's the kicker. Unlike a single massive hurricane that gets all the headlines, SCS is a high-frequency problem. You can have thousands of these events in a single year, which makes them incredibly widespread and ridiculously complex to model and manage.
Okay, so let's introduce our first key players in this whole debate, the insurers and the MGAs. These are the folks on the front lines, and for them, these models represent a tricky, high-wire balancing act between getting the science perfect and actually running a business.
And this right here is their central conflict. On one side, you've got the actuaries. They want the perfect technical price, a super precise number for the risk on every single policy. But on the other side, you've got the underwriters who have to actually write business, and they need to do it quickly and competitively. So the need for scientific precision clashes head-on with the need for speed. I mean, a perfect model is completely useless if it's too slow or too complicated to use in the real world, right?
Now, what's really fascinating here is that this table kind of maps out a path through that conflict. Using this framework from Lloyd's, you can see the difference pretty clearly. A company with a foundational approach is siloed. The pricing team and the underwriting team might as well be on different planets. But a company with an advanced approach, it's all integrated. The model becomes a tool for collaboration, where insights are shared and used to inform strategy across the whole business.
And this brings us to a really crucial point. For an advanced insurer, the goal isn't to get everyone in the room to agree on a single number from the model. No way. It's about having a transparent and really solid process. This quote from the Lloyd's framework says it all. When different teams have different views, and they will, the key is that the reason why is clear and it's written down. It's all about managing the disagreement, not trying to eliminate it.
Okay, let's bring in our second stakeholder, the regulator. Their job is to make sure that all this complex science leads to fair outcomes for you, the consumer. This puts their need for certainty and proof in direct conflict with the industry's desire for speed and innovation.
And the main tool they use for this is a process called prior approval. Basically, before an insurer can use a new SCS model to change the rates you pay for your insurance, they have to file a super detailed application with the state's Department of Insurance and wait for them to approve it. And let me tell you, this isn't just a friendly chat. It's a formal, often painfully slow process designed for intense scrutiny.
If we take California as an example, you can see just how deliberate this all is. An insurer has to submit a mountain of forms, provide a ton of justification for why their model is scientifically sound, and then, get this, that entire filing becomes public record for anyone to inspect. Every single assumption gets put under a microscope.
And just look at this list. This shows you the massive burden of proof we're talking about. It's not just one form. It's the application, a sworn legal affidavit, super detailed rate templates, a specific catastrophe model form, and a long memo explaining every single choice they made. For regulators, a model can't be a black box. They have to be able to see exactly how it works and defend it to the public.
All right, time for our third major stakeholder, the reinsurer. The easiest way to think about them is as the insurance company for insurance companies.
They aren't worried about your individual house policy. They are focused on massive aggregated risk across the globe and the pure science of the storms themselves.
This chart basically shows you the world from a reinsurer's perspective. They're looking at the entire planet and asking, where are the really big losses coming from? And as you can see, in the first half of a recent year, severe convective storms made up the biggest slice of the global insured loss pie. Their view, by necessity, is from 30,000 feet.
So for them, the most important word is aggregation. Reinsurers use these models to understand what's called tail risk, those truly catastrophic, once-in-a-century type events. They're looking at things like exceedance probability curves to ask, what would a 1 in a 100-year loss look like for our entire portfolio? Their ultimate question is all about solvency. Do we have enough cash in the bank to withstand a truly worst-case scenario?
So there we have it, 3 key players, all with competing priorities. And this means that what each one of them considers a good model is fundamentally different. It really is all a question of perspective, and it's driven by the specific risks each of them is trying to manage.
For the insurer on the front lines, good is all about being practical and profitable. They need a model that spits out a price they can defend to regulators, sure, but also one they can actually use to make smart, day-to-day business decisions. It's all about turning that complex data into a real-world, workable strategy.
For the regulator, good is all about public trust. The model has to be transparent, its assumptions have to be backed up by data, and the final rates have to be fair. Their number one job is to protect consumers and make sure the market is stable and solvent for everybody. And finally, for the reinsurer, good comes down to scientific integrity. They need to truly believe that the model accurately captures the physics of how these storms work. They need that scientific rigor to make billion-dollar decisions about their own capital and their ability to pay massive claims.
Okay, so with all these competing definitions of what a good model is, how in the world does the industry move forward? Is there a path that can actually satisfy everyone? Well, the answer seems to lie in building a more mature, more integrated framework that can bring all these different needs together.
Let's go back to that Lloyd's maturity matrix as our roadmap. Moving up this ladder from foundational to advanced isn't really about buying a better, shinier model. It's about building the right culture around it. An advanced organization blends the model's output with expert human judgment, and they have strong processes to check and validate everything. This is the approach that gets you a price that is not only technically sound, but also defensible to regulators and credible to your reinsurers.
And that really leaves us with the ultimate question, doesn't it? Because this isn't a problem that's standing still. Our climate is changing, these storms are getting more intense, and the data we have is getting more and more complex. So the core challenge for the entire insurance world is this. Can the evolution of our models, and just as importantly, our ability to use them wisely, actually keep pace with our rapidly changing reality?